If you have a checking account and you're over 60, whether you live in the United States or you are one of the thousands of Canadian seniors and snowbirds holding U.S. assets and accounts, the IRS quietly changed 3 rules this year, and none of them arrived in your mailbox. No letter, no public announcement, just new enforcement guidance buried in updated compliance targeting, and most seniors right now have no idea it applies to them. I'm covering all 3 today. The number you were told to watch that no longer protects you, the ordinary banking habit the government now treats as a red flag, and the family transfer that can quietly turn into taxable income. Stay until the end. The last one is the exposure most seniors already have without knowing it. Hey, I'm Dr. Elizabeth Thorne. At our agency, Smart Retirement, we break down financial and legal information every week that actually helps you protect what you've built and make retirement easier to manage. So, if that's useful to you, go ahead and subscribe so you don't miss what's coming. Here's rule number 1. The number most seniors memorized was $10,000. Stay under it, the thinking went, and you're safe. That understanding is now incomplete. Under the Bank Secrecy Act, any cash transaction over $10,000 in a single business day still requires your bank to file a currency transaction report with FinCEN. Your name, social security number, date of birth, and the exact time of the transaction filed within 15 days. You'll never see a copy. The bank is legally barred from telling you. What changed in 2026 is what the IRS watches below that number. Updated guidance now targets accounts showing consistent deposit patterns under $10,000, especially from seniors receiving regular benefit payments, family transfers, or retirement distributions. The threshold isn't your protection anymore. The pattern around it is. There's also a second report most seniors don't know exists with no dollar floor at all, a suspicious activity report, or SAR. A bank can file one on a $200 transaction. It's flagged by a compliance software watching behavior, not amounts, and you'll never be told it happened. Federal law makes it a crime for a bank employee to tip you off, up to 5 years in prison. Worth knowing, too, money orders and wire transfers over $3,000 also require the bank to verify and record your identification under the same law, even though no report is triggered at that level. It's a smaller version of the same record keeping the government already has on file. This applies at credit unions the same way it applies at national banks. There's no exemption for smaller or local institutions. If you've moved your accounts to a credit union thinking it operates outside these rules, it doesn't. Every federally insured institution follows the same Bank Secrecy Act requirements, which means the safest move isn't switching banks, is understanding what actually triggers a report in the first place. That leads into rule number 2, the one that turns an ordinary habit into a federal flag. Take Diane, 67, a retired county clerk in Albuquerque. For 11 years, she withdrew $800 in cash every 2 weeks for household expenses. After her husband passed, she raised it to $1,000 to cover bills he used to handle. 6 weeks later, her bank's software flagged the account and filed a SAR. Diane did nothing wrong. She was a widow adjusting her budget, and the system read her consistency as evasion. Diane didn't find out about the SAR until months later, when a routine account review at her bank flagged inconsistencies tied to the earlier report, and a compliance officer asked her to explain the change in her withdrawal pattern. She was able to clear it up because she still had old receipts showing the increase matched new bills she'd taken over after her husband's death, but she told me she had no idea until that conversation that anything had ever been filed on her account at all. That's called structuring. Under Title 31, Section 5324, and it does not require intent. It only requires a pattern that looks like an attempt to stay under the reporting threshold. Regular withdrawals of consistent amounts below $10,000 qualify, regardless of where the money came from or how clean it is. If you use cash regularly, the fix is documentation. A simple note each time with the date, amount, and purpose. If you use cash regularly, the fix is documentation. A simple note each time with the date, amount, and purpose. If you move larger sums between your own accounts, do it in one transfer instead of several smaller ones. Before the last rule, check your last 90 days of transfer. If you see 3 or more deposits between $5,000 and $9,500, write that down. You'll want it for the steps at the end. Now, rule number 3, the one involving money that never felt like income. Your daughter sends $400 through Zelle for groceries. Your son sends $600 through Venmo for a car repair. None of it felt like income, but under updated 1099K rules, third-party apps like Venmo, PayPal, and Cash App must report cumulative payments to your account once they cross a set threshold in a calendar year. $2,500 for 2025 activity, phasing towards $600. Zelle works differently since it processes as a direct bank transfer, so it isn't subject to this same reporting rule, but the income itself is still taxable if it's actually business related. When a processor reports those transfers and you don't show them on your return, the IRS computer flags the mismatch automatically. That letter is called a CP-2000, not an audit, but a proposed adjustment with interest attached. Patricia, 71, a retired home health aide in Memphis, got one in March claiming she owed $1,840. She hadn't worked all year. Her 3 adult children had sent her $3,200 total through Venmo for prescriptions, bills, and a new refrigerator. The IRS matched the $1,099K against her return and found a gap. She had 60 days to respond before it became an automatic assessment. The fix: have family members note personal gift in the memo line when they send money, and keep a simple log. Gifts aren't taxable income to you, but you need to be able to show that's what they were. One more thing most seniors don't realize: the IRS generally has 3 years from the date you filed a return to question it, but that window stretches to 6 years if the unreported income is more than 25% of what you actually claimed. That means a payment app mismatch from 2 or 3 years ago can still surface today, even if no notice ever arrived at the time. If you've been receiving regular family transfers through these apps for years without tracking them, it's worth pulling your last few years of app history now, not just this year's, so you're not caught off guard by a notice covering a year you'd already forgotten about. So here's what I want you to do. To help you protect everything you've built and navigate these shifting compliance rules without spending hours digging through government updates, our team at Smart Retirement has put all these safety steps, red flag patterns, and cross-border protection steps into one fast, simple guide. It's called the Smart Retirement Money Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now stay right here, because the last rule is the one most seniors are already sitting on without realizing it. And it's the reason I made this whole video. Here's your action plan, and do these in order. Step 1, request your free check systems report and check it for flags or closures you weren't aware of. Step 2, for the next 90 days, log every recurring deposit, source, amount, date. If family sends money through an app, get a one-line note from them confirming it's a gift. Step 3, consolidate any planned transfers between your own accounts into one move instead of several with a brief memo describing the purpose. Step 4, add up every Venmo, Zelle, PayPal, and Cash App payment you've received over the last 12 months. If it crosses $2,500 and isn't on your last return, gather your documentation now before a CP-2000 arrives. Step 5, if a CP-2000 arrives, respond in writing before the deadline on the notice, usually 60 days from the date printed, not the date you opened it. Include a brief explanation, documentation, and a signed statement. If the proposed amount is over $5,000, loop in a licensed tax professional first. Step 6, place a free security freeze on your check systems file if you're not opening new accounts soon. It won't affect existing accounts, but it limits how your pattern gets shared with screening tools going forward. None of these 3 rules came with a warning. Your bank can't tell you a SAR was filed. The payment app won't notify you when it reports your family's transfers. That silence is built into the law. Knowing the actual rules and documenting as you go is what keeps a quiet flag from ever becoming a real problem.